Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Okay, friends, family, and followers, it's Charlie Jewett coming to you with the 69th episode in a row. Actually, I guess it was 70 because I did a 000 episode. I did a 000 episode. I'm in Chicago again, believe it or not, 2 weeks in a row, baby. This time I'm here with my daughter, my beautiful daughter. We are doing financial seminars for an advisor who listens to the show. So we're going to meet with his clients, do financial seminars, teach them about the 5 Lives of Retirement and all the things that I teach on this podcast. So what is episode 69? I'm so glad you asked that. Episode 69 is called The IRS Spells Theirs. Have you ever done that? Have you ever taken the two words, The IRS, and put them together Sesame Street style when they used to dance the characters that were far apart? Near, far. And then they'd put them together. You put The and IRS together and it spells theirs. And that's what the IRS thinks. That's why they've been created. They try to take our money and make it theirs. Now, first thing to understand as we go into tax week here. So yesterday I did an interview with tax expert David McKnight and his book, The Power of Zero, and also his new book, Look Before You Lerp. And this is kind of tax week. I don't know if it'll be 7 shows or 4 or 5, but I'm going to focus on taxes here for a little while. So, first thing to know about the IRS is they are not the bad guys. The fact that they collect tax revenue does not make them bad guys. It's just that they have one job to do: raise tax revenue for the United States. Now, taxes are an asset. People usually do not think of them that way. The author Douglas Andrews taught me this 11 years ago. I thought it was fascinating. Taxes are an asset. If we didn't pay taxes, the roads would have potholes in them. We wouldn't have police and firemen helping us when our houses are burning down or somebody's breaking in. There's all kinds of wonderful things that taxes cumulatively pay for that make our country an incredible place to live. Now, should we pay more, or do we want to pay more taxes than we have to? Absolutely not. Paying the exact amount of tax that you are supposed to would be the way to go. The IRS, they're not the bad guys. There's certainly some things they do that I don't like, but they're not the bad guys. They just have a job to do, which is to raise tax revenue. Now, taxes, tax planning is a game, and games are fun when you know the rules, number one, and they're a lot of fun when you have good players on your team. Remember when we chose captains in school and you picked players? And you picked really good players first because you wanted to enjoy the game, maybe win the game and have a lot of fun? That's the way it is with tax planning. You've got to know the rules and you've got to have good players on your team. The Michael Jordan of tax planning would be so much fun. So, what's the game we're playing? The IRS's job, it's their job in the game, is to take what's yours and to make it theirs. What is our job then? Our job in this game is working together, is to take what's yours and keep it yours. We're playing hide and seek with the IRS. We don't want them to take the money. Well, we're not hide and seek. We don't want to be hiding money from the IRS, which could be illegal. But what we want to do is use all of the possibilities, every strategy possible. Mortgage planning strategies do an incredible job here. Using cash value life insurance, Roth IRAs, reverse mortgages, all kinds of cool tax strategies you can do with all the different parts of merit planning, which stands for mortgage plan, estate plan, retirement plan, insurance plan, and tax plan. So, our game is to keep as much of the money in your pocket as possible, only give to the IRS what is rightfully theirs. Now, what's the most successful move in this game that the IRS has ever done, or the most successful card they've ever played, let's say? In my opinion, and I'm going to do an entire show on this, the most successful card they've ever played is the qualified plan, the introduction of the 401k, the 403b, 457s, IRAs, things like that. Now, why do I say this is the most successful card they've ever played? Well, they created a tool. The IRS created a tool that was supposed to be a tax savings vehicle. Now, let's just stop there. What is their job in this game? Their job in the game, or the reason this entity exists, is to raise tax revenue. They're trying to get money that's ours and make it theirs. Why would these people ever create a tax savings vehicle? Think about that. It doesn't make a whole lot of sense. Well, what did they do? They created a vehicle and they said to us, if you put money in now, we will save you taxes. You can deduct the contributions And then, later on when you're going to take money out in retirement, we'll just charge you the taxes then. And an interesting phrase emerged out of this, which is when you're in a lower tax bracket. Hey, postpone taxes to a later date when you're retired and you're in a lower tax bracket. We'll talk about that later in this week, why nobody's in a lower tax bracket in retirement unless you choose to be poor and take a lot less income. But this is the game or the play, the move that the IRS made is creating tools where you get a tax deductible contribution. If you put in $6,000 this year, take it off on your taxes. It might save you from paying $2,000 of taxes, and then you postpone that until later when you retire and you're taking out an income, you'll pay the taxes then. Well, let's just talk about this. Should you pay tax on the seed or on the harvest, which comes from the book Misfortune 101 from Douglas Andrews? You can get that book on my website. Go to jewetwealth.com, Jewett. On the right-hand side at the top, you click More, and then you go to the Books That I Recommend section. Misfortune 101 is kind of the Bible of the things that I taught for the first 9 years, and there's some other strategies now that I just think are fascinating as well. So good book, good book, good book, good book, good book, good book. All right, where are we? Now, paying tax on the seed instead of the harvest. How does this work? Let's say I live near a town called Julian, California. It's outside of San Diego, and it's an apple town. So it's kind of an apple pie town. Nice little place in the mountains where you drive up there. Kids get a little bit sick on the windy roads, but we go up there, have apple pie, walk around. Let's say you got sick of the rat race. You were working in downtown San Diego, got totally sick of the rat race and wearing a suit and said, I'm going to become an apple farmer. I'm moving to Julian, getting myself a little cottage with an apple farm, and I'm going to make apple pies. I'm going to sell apples. And you get there, you get into town, you've got your farm, you go into the store, and you're going to buy your seeds to plant your apple trees. And the store owner says, all right, I got 2 plans for you. You can buy this bag of seed, it's $20, and you can pay your sales tax, which is $2. I'm just making this up. So you're going to spend $22 today, and then all the apples you sell for the rest of your life, you get to keep all of the proceeds yourself. All right, that's plan A. Then he says, I've got an incredible second plan, plan B. In this plan, you don't pay any taxes at all. When you pay for the seed, you give me $20 only. You don't have to give me $22. It saves you the $2 of taxes today. Isn't that fascinating? Well, what's the catch? Oh, it's nothing. I mean, when you sell your apples later on, every apple you ever sell from the farm, I get 10 to 20% of the proceeds in an apple tax. So you don't have to pay taxes today. We're going to postpone them to a later date, and I'll just take my taxes at that time. Well, which plan would be better for you people? Do you want to save $2 today and give up 10 to 20% of everything you make for the rest of your life on your apple farm? Or would you rather just pay the $2 and get it over with and then keep all the revenue when you harvest? So paying tax on the seed or paying tax on the harvest is a pretty big deal and a decision you need to make. We're going to talk about that tomorrow when I expose an incredible lie that you've been told, where people say, hey, if you put money in and you don't pay taxes, there's more money in there and you've got triple compounding and you're making more money. It's actually completely false. You're not making any more money whether you put it in pre-tax or post-tax. You'll see that tomorrow. So the most successful card the IRS has ever played for sure is creating these ways to save a small amount of taxes today so they can tax you on the large amount. But, why are you saving money? To keep it small? No, you're saving money, putting in $6,000 a year, hoping it turns into $400,000 or $500,000 or $600,000. That's what you're then going to owe taxes on to the IRS. They know this. It's the best move they've ever made. Now, let's talk a little bit about marginal versus effective tax rates, because this gets people confused. When you have a marginal tax rate, well, that was fun. As I'm here in Chicago recording this podcast on taxes and tax planning, the advisor who brought me in to teach seminars pulled me into a client meeting where the guy's got a couple of $1 million. He's terminally ill, and he's trying to leave money tax-free to his kids, but he can't get insurance, which is the easy way to do that. So we had to talk about how to make it tax-free, how to divorce the IRS. That was fun. Anyway, back to teaching you. Marginal tax rates versus effective tax rates. So a lot of the really good books on tax-free retirement and things like that, or on the kind of things that I teach, will talk about the 33% tax bracket or the 27% tax bracket, which I'll use in an example in a future show, or actually in the end of the show. So, and then people go, well, I'm not paying 33% tax. I'm not paying 27% tax. Last year I made 100 grand. I paid 17,000 in taxes, so I'm only paying 17% tax. Well, this is the difference between effective tax rates and marginal tax rates or marginal tax brackets. What's the effective tax bracket or the effective taxes? That's the total tax you pay across all brackets at the end of the year. So in that example, if you do make $100,000 a year, and you only paid 17,000 in taxes, your effective tax rate is 17%. However, the top dollars you earned, right? So let's say you made 100 grand, you had 30,000 in deductions. Those top dollars you earned, up to $70,000, those were not taxed at 17%. Those were taxed at a higher rate, maybe 25 or 28. Whereas the early dollars, right, the first 10,000 or the first 20,000 may not have been taxed at all, may have been taxed at a 10% rate. So some of your money you pay nothing, some of it you pay 10%, some you pay 15, some you pay 25, some you pay 28. Those are brackets that you're moving through. When you move into a bracket like the 28% tax bracket, it doesn't mean all the money you make that year is now taxed at 28%, like you made some huge mistake that's going to cost you. It just means you made enough money where now the dollars from that amount up, any more money you make, are now taxed at 28%. Well, why is this so important? This is important because tax deductions, any strategy that you use to lower your taxable income, does save you those higher amounts. It saves you the marginal tax rate, not the effective. So you can save yourself 25% federal, 28% federal, plus 6, 7, 8 to 11% state tax. You can save yourself, 35% tax by using deductions and using tax strategies, and that is important. So when you hear me reference in the next little segment here, paying 27%, don't say, oh, that's too high. Many people are paying 27% on the top dollars. So let's finish up like this. Let's talk about a dollar doubling. Many of you may have heard this. I love this. When I first heard this, I thought it was the coolest thing in the world. I absolutely love this. If you double $1 over 20 periods, okay? If you double a dollar over 20 periods, it turns into $1,048,576. Now, that's just stinking cool. That's just awesome. The way money compounds. I don't have an investment where you can double your money, but this is true if you're compounding, at 8%. It still does magical things, but doubling a dollar 20 times, you end up with $1,048,000. That is awesome. That's the way it would work if it was tax deferred or tax free. Now pretend with me for a moment that you taxed it at just 27% along the way. What would happen then? What would you end up with? This is shocking, but most people would never believe this, but rather than $1 million and $48,000, you end up with only $57,666. Now, you didn't hear me incorrectly. $57,000. You end up with 18 times more money if it's not taxed at 27%. So let's just break this down and talk about it a little bit. The same growth, whether it be realistic or not, doesn't matter. The same growth, a dollar doubles over 20 time frames. Can be a day, can be a year, can be every 5 years, doesn't matter. It doubles over that time frame, and if you tax it along the way CDs would be taxed, let's say, as earned, at just 27%, you end up with $57,000 instead of over $1 million. Do taxes have an impact? Yes. Are taxes the most important thing in retirement planning? Probably yes. Could you trust or work with a financial advisor or retirement planner who does not take into account taxes and tax planning? Absolutely not. That would be incredibly dangerous. One of the most important things in compound interest is, are you paying taxes or not? So earning or paying taxes as earned is the worst way to go. It takes, the $1 million away from you. So let's talk about the other one. Let's talk about tax deferred or tax free. Both tax deferred accounts and tax free accounts, if a dollar doubles for 20 periods, you end up with $1,048,000. Well, that's great. However, the tax deferred accounts, here's where the IRS, which spells theirs, they think the money is theirs, they try to make it theirs. Here's where their genius move really pays off for them. Tax deferred accounts, where they got you to save taxes on the small deduction. Now you've grown to $1,048,000. What piece of that belongs to you and what piece of that belongs to the IRS? Well, the answer is the biggest piece they can get passed through Congress. So right now they get, I don't know, about a third of it. So $300,000, $400,000 of this account belongs to the IRS. So you really only have, $600,000, $700,000. What if it's inside of a Roth IRA or inside of cash value life insurance? You can listen to my episode entitled The Rich Man's Roth IRA, or Roth IRAs with no contribution limits. You can do $100,000 a year to it if you want to. IRS knows about it. They know, on your tax return, they can see it, doesn't matter. If you use life insurance or Roth IRAs and you grow an account to $1 million, $1,048,000, every single one of those dollars is yours and you get to keep it. So do you want to have, $57,000, $650,000, or the entire $1,048,000 to be yours to keep? People, that is what tax planning does for you in your retirement plan. The reason I'm so passionate about merit planning, mortgage plan, estate plan, retirement plan, insurance plan, and tax plan, is not because I'm a junkie or an overachiever or try to be a jack of all trades. It's because there is only one type of planning: financial. Everything that affects your finances is a part of retirement planning, because retirement planning is about how much money you end up with and how much income it creates. So just a little introduction today to tax week. Well, tax week started yesterday, so I'm doing an introduction after I started it. That's cool, but I'm kind of a weird guy. Just to start out here, $1 doubling, all the different ways it could be taxed, and tax-free, of course, beats everything else, particularly if taxes go up. I'll talk to you tomorrow about some more cool things. I think you people are the best.
Renovating retirement with Charlie Jewett.
That's all, folks.